Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for December 15, 2021. What I would like to do on this segment is to share with you the latest report that we published in the Associated Press. What's up with gold? This is the Equity Management Academy Mean Reversion and Trading weekly podcast for December 14th, 2021. Summary. The Producer Price Index came out with the biggest number in 40 years. Gold is down 6 or 7% for the year, and silver down 14% or so for the year against these levels of inflation, which are at 40-year
highs. The past few meetings, the Fed has just talked the markets down, but has not actually done anything. If interest rates do go up aggressively, it puts the world economy at tremendous risk, and defaults will become common. It is a global problem, so governments will have to find a way to hedge against this tremendous debt bubble by allowing inflation to run at higher levels than expected. Fundamentals. The Producer Price Index came out with the biggest number in 40 years. Gold was down, but we are beginning to see a bit of a correction. The CPI is at 6.8%. These types of numbers are not transitory. It puts pressure on the Fed to raise interest rates sooner than later. Doing that will be a challenge, with debt far above where it was in the 1970s, when debt was below $1 trillion. Interest rates hit 19%. Today, we have a negative interest rates in effect and massive debt. Today, we have a very different dynamic than in the 70s. The 10-year note is at 146.70, up 4 basis points. It's not reacting to the inflation fear that we seem to be seeing in the markets and record levels on the CPI and PPI. It is abnormal for gold to be down at these levels, Equity Management Academy Patrick MontesDeOca said. We have inflation at highs not seen since the 1980s. Yet gold is down. Gold is down 6 or 7% for the year, and silver is down about 14% or so for the year against these levels of inflation, which are at 40-year highs. Precious metals have been around for thousands of years. We are in the midst of a monetary system that is adjusting to these new levels of inflation. This acceleration of inflation has been caused by the Fed's massive expansion of the balance sheet to record levels. There is a lot of money in the system, which is causing price inflation. We also have less supplies than anticipated, since companies did not store much inventory in expectations that the pandemic would continue to suppress demand. Now, demand is far, far above supply. A key issue is now whether this level of inflation has become integrated into the system. If it is not transitory, then the Fed and the markets are in a dilemma. The Fed will have to talk about tapering and raising interest rates, which could devastate the economy. The past few meetings, the Fed has just talked the markets down, but has not actually done anything. The digital markets, precious metals, and other markets have come down far below their mean. We could be seeing a sell the rumor about tapering and raising interest rates. And when the Fed makes its announcement, the market could run up. Sell the rumor and buy the fact effect. Having already discounted the possibility of an interest rate rise, MontesDeOca said. The E-mini S&P is down 30 points on the uncertainty, activating a short trigger from 4,687, according to the variable change in price momentum indicator, the VCPMI. If we come down below 46.32, then a bearish price momentum will be activated with targets of 45.24 to 44.69.
Let's take a look at the markets here for a little bit here. We have the FOMC meeting today coming out and are going to give us an idea of what they are going to do with interest rates. The markets are going to be a bit choppy here this morning, waiting for any kind of direction. So let's just watch the markets here for the time being and see how they are going to be affected here by this anticipated FOMC meeting for the end of the year. We've come down to 2163 on silver, which is the daily signal, and it's trading below the weekly signal again of 2181, but it is in an area where it is indicating that this is support. This is a major area of support. So what we want to see is buyers come in here and begin to accumulate supply at these levels. The gold market is trading below the weekly buy one level of 1771, and it is also in an area of support. Trading above 1771 will activate a weekly buy trigger once again. expect today to be very choppy, and we're taking a pretty conservative attitude here today for day trading, as I think it's going to get pretty wild here as we move into the FOMC meeting. I am interested, if we do come down into this 1756 area, 1752 ideally, to get on the long side. I think those levels offer the highest probability to get long. We have a lot of red on the screen here in reaction to the possibility that the Feds are going to raise interest rates. And, you know, it really is something that no one knows what the markets are going to do, because if I can give you my opinion in terms of how I look at this market, the markets come down without the Feds doing anything. It's all been talk about tapering, talk about raising interest rates, and the markets have reacted to that bearishly. Prices since June, actually, which was the last meeting that Chairman Powell indicated that they're going to begin tapering talks, we saw the market basically come down quite a bit across the board. So I'm watching for the possibility that, in this case, sell the rumor and buy the fact might be what the doctor ordered. Because prices have anticipated, and they always anticipate any changes that they expect from the Fed. I think surprise is going to be if the Feds are going to meet the expectations that the market is waiting for, and that is essentially for them to begin tapering faster and to get closer to raising interest rates. And I really have a concern in terms of how the Feds are going to establish the monetary policy here without disrupting the markets, without causing temper tantrums here. Because although we are comparing inflation once again back to the 1970s, the fundamental situation and the monetary policies are completely different. We had less than $1 trillion in debt. Interest rates were at the high of the move, were around 19% in 1981. And inflation was running at record levels. Gold was trading $850, $900 an ounce. The Dow Jones was at $1,000. The spread of gold to the stock market was a 1-to-1, almost. And needless to say, it went to 30-to-1 since, as we made record highs in the stock market here. So the fundamentals have changed quite a bit, and we're not in a position to raise interest rates aggressively when we have close to $30 trillion of debt, not including unfunded liabilities. We're running debt at 120% to GDP. And this is not just an issue with the United States. I think we have a global issue as a consequence of this pandemic that we saw, which essentially required for central bankers to and treasuries to print as much fiat currency as necessary to cushion the blow, you might say, of the potential crisis that could have developed, which was without the stimulus, obviously, the situation would have been a lot worse. As it is in 2008, I think the policy of printing money began aggressively, and we have seen just since the debt explode. The balance sheet of the Feds is at record levels. And so it's a really unusual situation that we're finding ourselves with this anomaly, you might say, that it's meeting or going beyond any expectations of demand coming back into the market after the pandemic. But the problem is the economy is facing with shortages of these supplies, not to mention that it underestimated the demand coming back into a normal economy. And so we have a potential, bottleneck supplies. We have a new threat of Omicron. Infections are increasing tremendously, and it increases the risk, basically, again, of a widespread situation unfolding here on a global basis with regards to the Delta variant, and the Omicron. So we have another issue to deal with, and I think it's making a lot of people nervous in going back to work. Countries like London are beginning to recommend their people to work from home again. And so, are we going into another world lockdown of some kind? I really don't believe that's the case, but I think it's going to be selective. We can't afford another world lockdown. The economy as it is running the danger, basically, as we continue to print more money, to accelerate into hyperinflation if we continue to do this. So there has to be some other measures that are taking place, and I believe that on the face of the Feds commenting how aggressive they're going to fight inflation, I think what they need to do is they need to allow for the inflation on the short end of the curve to adjust to market conditions while they cap the interest rate on the 30-year bond. The danger is that if we do see a rise in interest rates in the 30-year bond, that would be very dangerous because most of the debt is on the 30-year bond. So at a worst case scenario, I believe that the time could come where the Feds can cap the long-term interest rates while they allow for the 10-year note or for the short end of the curve to adjust to the inflationary pressures that the Feds are calling transient. So we're going to remain pretty quiet here today. We're going to maintain our positions, our core positions intact, and be prepared for tremendous volatility as we move into the FOMC meeting. Very quiet in gold here, 1768.50. Bitcoin is coming down to the buy one level of 46,787, which is the daily buy one level. In a very, very, very quiet market. The markets are drifting. So not a lot of volatility today yet in terms of trading. So continue to hold on to your core position. We have the metals markets at levels of support. Again, I'm just checking out the TradeStation platform where the algorithm is written in C++, easy language here. It's coded in C++. We are at what I believe are extreme levels below the mean. Again, I think today's action is going to be influenced by the talk of Chairman Powell in terms of how he is going to handle interest rates. And I think the markets are going to react to it. I'm not so sure, again, how much more these markets are going to react without any policy being implemented. As opposed to, getting an indication that it might have been already discounted in the market, whatever they're going to do. Markets always get ahead of the fundamentals. So let's see if this is the case as well. Let's continue to hold on to your core position, my friends, and join us here every morning. Click and link to subscribe. We are offering a 2-week trial for the Discord private trading room that we run literally 23 hours a day. Join us. In the meantime, be safe. Good luck today. I'll talk to you soon.